Stephen Yu, CIO at Blue Whale Growth Fund, is joining us this morning. Stephen, great to have you on the show.
Good morning.
I have been thinking about your positions in the context of the sell-off that we watched last week. And I'll start the conversation by getting your thoughts in terms of what did you change in the portfolio last week?
So we haven't changed anything. I would say that it's just one of those times that when you're approaching at a point that everyone is making a lot of money from AI, I think over the last year or so, then people want to have excuses or reasons to basically take profits. And I think last week was probably a combination of the US government continue to be shut down, and then there's bits of probably not a lot of news on the back of AI, and people just want to take profits. And basically we sit tight and manage to stay tight with our positions.
So you didn't find there was perhaps an opportunity to increase some of your positions?
I mean, we have decent exposure to artificial intelligence, as we have spoken about this since the beginning of this year. I would say that within the portfolio, we have about a quarter of the fund. I think what we have done, though, over the last couple of months or so is we have gone more into memory and data storage, just because we think as part of the AI infrastructure play that we are going to see more machine-generated data than anything that the human population has been on record. So you would need to have an upgrade or refreshment cycle in memory and storage, such as Hynix or Seagate.
So how are you thinking more broadly about the concerns that we witnessed last week in terms of AI valuations? Are you using that as an opportunity to look at other parts of AI that perhaps are less exposed to the high levels of debt here?
Yes, I think there's three layers to that. I think firstly, when you talk about the AI infrastructure companies such as Nvidia or Broadcom, which we have decent exposure to, the valuation is actually quite reasonable, right? Like if you look at Nvidia's PE ratio 1 year forward, it's about 30 times earnings, which is very similar to Microsoft, Apple and MasterCard and some others. But at the same time, if you look at some of the VC-backed AI companies that have no profit or with an idea, no business model, I think the valuation some of these companies are trading at or being acquired or funded are at a very extreme end. So I think where you want to be positioned is you want to position into at companies that are highly profitable. At the same time, they have a sustainable business model in terms of where we are heading from here. So I think it's a difficult one in a way that you just need to be very selective. And as you know, that we don't own any of the AI spenders, such as the Mag 6, so we are a bit concerned about the return on investment going forward.
Yeah, we've talked about how you sold your position on Microsoft some time ago. I would like to go back to Nvidia because, as you've mentioned, you've had shares of Nvidia for a long time. How are you thinking about the outlook here for exports into China?
I think it's probably an optionality in a way that it would be an upside for Nvidia share price, just because if you look at Nvidia's earnings or outlook for the next coming years, there's no China's revenue. So if we are thinking about, okay, Nvidia is going to deliver at least $250 billion in revenue next year, and then maybe $300 billion the year after, there's no Chinese revenue in that. So then I think any news would be very helpful to the shares, but of course that's not our base case scenario.
We heard from Jensen Huang. He had some controversial comments in terms of who's winning the AI race, China or the United States. My question to you is, when you are thinking about portfolio, are you increasing your exposure to Chinese AI companies?
We don't currently have this, but we do share Jensen Huang's comment, just because I think when we talk about AI regulation in Europe in particular, I think it's probably going into a phase that is going to become like a constraint in terms of development. If you really think about what AI is about, it's about personalization. At the same time, it's about data that's readily available on the cloud that can be readily analyzed. So then if you just think about regulation could actually put a dent in terms of the development cycle. But of course, in Asia or maybe in China, that concern would be a lot less. So they would be able to train or to come up with use cases a lot quicker.
So does that mean that this is a moment to increase exposure to Chinese AI names?
I think on a high level, if you're taking a long-term view, you probably want to have the best of both worlds. in the coming future. Just because if you think about Nvidia or Broadcom or even some of the big tech names that are developing a lot of AI applications, it's very unlikely those applications would be going into China, and vice versa. If you think about the Tencent, the Alibaba, and some others, or DeepSeek in China, though a lot of those applications is unlikely to be coming over to the Western world. But of course, China is a big market. I mean, they have 1 billion of the population. At the same time, they do have certain airlines that might be using some of the applications. But I think the difficulty where we sit in Europe is like in Europe, it seems like we do not have much to counter. So then ultimately, you probably have probably like two worlds of AI. One is in Asia, probably led by China. The other one would be in the Western world, led by the US.
So when it comes to Europe, last time we spoke was back in July, and we were discussing your investments in European defense. So if you're not looking at the European AI names at this stage, how are you thinking about European defense?
European defense is actually okay. I mean, we spoke about this a few times this year. But
I've noticed, if I may follow up, that Leonardo is no longer among your top 10.
Yes, that's right. Just because, I mean, obviously, Leonardo share has done very well on the back of Trump's election coming into the office this year. And Leonardo share price has almost doubled year to date. So from our perspective, we have actually taken quite a lot of profits. I mean, the position size now is smaller than the beginning of the year, despite the fact that the shares almost double. But the reason being is the transmission mechanism for European defense in terms of the spending, which we still believe there's more spending going to be invested in defense. But at the same time, the infrastructure built up, how that get translated into the profit of Leonardo or some other European defense company is going to take a bit longer. So then when you look at the valuation, which in contrast to artificial intelligence is only about data that you can actually utilize, and a lot of people are adopted AI already, that it's going to take a bit more time. So we are a bit cautious on valuation, and as you're right, that Leonardo is no longer in our top 10 holding.
It's interesting you bring that up, because yesterday we also had a discussion in the show comparing the European defense outlook versus US AI names. But bringing the conversation back to Europe, I also noticed that Moncler is among your top 10 at this stage. Is this where you are increasing your exposure in Europe, looking at luxury?
So it's an interesting one. Obviously, we have had Moncler for the last 2 years or so. I think we have been quite patient in terms of waiting for recovery. I mean, this year we also have another company called Burberry. So we have Burberry alongside Moncler. I think what we have seen so far on the back of the result season a couple of weeks ago from different players, that it seems like maybe the worst is over. Right, the worst, as in like the Chinese consumer are still not overly spending, but then at least the numbers are not getting worse compared to before. So I think that at the moment there's a bit of valuation support, or maybe you would think like they are on a path of a recovery. But I think our concern is it might take a bit longer as well. So then I think you can definitely get some outperformance from your luxury brands. But then if you're thinking about they're going back to the good old days of the Chinese coming back in full to spend a lot of money, I think that's unlikely at this point in time, unless China is going to have some policy that might incentivize their population to do so, which is also not in our base case scenario. But I think valuation very attractive, and we see some signs of recovery.
Stephen, we have roughly 2 months, if that, left in the year. What is the one call that you're making at this stage as you prepare for year end?
It's a difficult one, but recently, if you might have noticed that we have got ourselves into a gold miner, which is Newmont, and it's now become in our top 10. Of course, I think the question is whether we're a bit late to the party, but I think what we're seeing though is it's not just only about the weakness in US dollar, which might not continue for next year. It could be the other way around. But I think is the overall concern about the fiscal deficit and also the US dollar losing the status as a reserve currency. So then when you think about gold, okay, at the moment it's about $4,000. It's already done quite very well. But then if you really think back about the Bretton Woods era, there's a lot of faith from many foreign countries that wanted not have gold, but have the US currency as a reserve for the last many years, and I think Trump probably have changed that. So we do think that as far as in the gold space is concerned, that could be some opportunities going forward, even though that is already done quite well.
Okay, well, let's see what will happen. Maybe let's return to the conversation in the new year. Thank you so much for joining us today. Stephen Yu, CIO at Blue Whale Growth Fund.